Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is pull up any equities underlying in your brokerage account. We're just using UAL because we've got a position open at the moment, but any equities underlying is fine. You just want to get up a list of expirations and the purpose of this step is to lock in on an expiration date for when we mock up positions. And the expiration date that we select needs to be between 30 and 60 days out in time. And it also needs to be a monthly, not a weekly or quarterly expiration. And the only expiration date that actually fits that criteria right now is January 17th, which is 57 days out in time. So we can take that information, come over to our watch list, and filter out all underlyings that have earnings over the next 57 days. We do not want earnings to come along whilst we're in our trade. Earnings will increase volatility, it will mess up our deltas, etc., etc. All of these things will have a negative effect on our P&L. So we want to stay away from that. And we also want to filter out anything with a low liquidity rating level. The purpose of this is to ensure that we're only trading highly liquid underlyings with liquid options, with a liquid options market, so that we only pay tight spreads and we can get in and out of positions relatively easily. So now what I personally like to do, this is just a matter of preference. I like to order the list from high to low IVR. The reason for this is because, of course, our edge is that volatility or implied volatility is always overstated, well, most of the time is overstated. So we want to, and also volatility is mean contracting. Volatility is a mean reverting product. Sorry, that's what I meant to say. It's a mean reverting product. So we want to sell when volatility is high, play the contraction back down to the mean, and hopefully take some profit off the table. So that's why I like to sort it like this. Some people like to do it from, highest percentage change, whatever it is that tickles your fancy. It doesn't matter. Generally speaking, an IV rank of over 50 is considered high, and sometimes over 30 can be considered high. So we just go down the list at this point and we simply see what would fit well in our portfolio. NVO seems to be looking nice at the moment. It's trading at just over $102 per share. It's got an IV rank of 101.5 and an absolute IV level of 53.9%, which is good numbers. So if we open up the uh, our expiration dates, and we already know we're going to be at January 17th. We're now presented with the options chain, and at this point, we do what we always do: we sell one call and one put, anywhere between 15 and 20 deltas. So we've got 21 delta on the call side, and then on the put side, we've got a 21 delta there as well. So we've essentially created a range for ourselves between 90 and 120. Um, and this would allow us to collect $441 upfront. Our broker is going to require just over $1,000 in buying power. So this is a very, very nice return on capital trade here. We've got 69% probability of profit and an 89% chance of hitting 50% of max profit at some point over the next 57 days. So we've got we've got a very, very high probability of success here. And we've got a very nice return on capital as well, especially for it being a naked position. Now, if $1,000 was too much for your account, that's fine. You can just simply buy another contract a little bit further out. $5 wide on the call side, $5 wide on the put side. And that's going to reduce the amount of premium that you collect, but it's also going to reduce the amount of buying power that's required. Generally speaking, covered positions like this have a higher return on capital than naked positions, but the return on the naked position was very high in the first place. So if you don't need to cover your shorts, it may be best to just play this as a naked position. Your probabilities of success will suffer slightly as well. With the markets, there is no such thing as a free lunch. In order to get something, you have to give something. So, we no longer have an unlimited loss potential, but we have lower probabilities of success. So that's the trade-off, or one of the trade-offs. And how do you know how much buying power you should be allocating to any given position? Well, in order to figure that out, we've created a position sizing template. Link is in the description. Click on this button here, free position sizing template, and it will take you to this spreadsheet. The way it works is you enter in the size of your portfolio at the top, and then below it, you enter in what the current VIX level is. Everything below that will then be automatically calculated for you. And at that point, all you need to do is just use this information to form the backbone of your portfolio. It will tell you exactly how much buying power you should be allocating to any single defined, undefined risk position. Um, and like I say, to get a copy of this link, just click on this free position size template. It's free. As long as you follow this, you'll be absolutely fine over your trading career. If you want to learn in more detail, again, link in description. This time, click on EDS Premium. Get yourself signed up. Once you're inside, you will have access to our portfolios that will allow you to see the trades that we're placing. It will allow you to see how we're managing risk, how we're making adjustments, all in real time. There's also a full course inside as well, so no prior knowledge is required. We will teach you absolutely everything you need to know. It's a private community, so if you get stuck, you can speak with other like-minded individuals. You can also speak with myself directly. There's a 100% money-back guarantee. So once you have studied through the full course and followed our trades for at least 6 months, if at that point you haven't been profitable, or you don't know what you're doing, then we'll work with you for free until you do. Or you can simply request a full refund. So it's completely risk-free on your part. And right now, it is only £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.